Inflation in the US is finally showing signs of cooling down, bringing some much needed relief for the Federal Reserve. This week's inflation data suggests that the Fed is close to hitting its long standing target of 2%, and the recent rate cut just a few weeks ago might be helping guide things in the right direction. For September, both consumer and producer price indexes came in around expectations, pointing to a slowdown in inflation. The big takeaway here? Inflation is starting to drift closer to that 2% goal the Fed has been aiming for. In fact, economists at Goldman Sachs believe the Fed might already be there. They're predicting that the Commerce Department's Personal Consumption Expenditures, or PCE, price index for September will show a 12-month inflation rate of 2.04%. If that's the case, it would be rounded down to 2%, which is right in line with what the Fed wants. That would mark a big milestone after more than 2 years of aggressive rate hikes to combat inflation. So why does the Fed care so much about the PCE? Well, it's one of their favorite tools for measuring inflation, even though they use other factors to make their decisions. The good news is that we're seeing inflation come down a lot over the past year, and the job market has also cooled off to a level that seems just about right for full employment. This is all according to Austin Goolsbee, president of the Chicago Fed, who spoke on CNBC after the latest consumer price data came out. But of course, it's not all smooth sailing. There are still some challenges ahead. While prices aren't necessarily dropping from the highs we saw a few years ago, the rate at which they're increasing is definitely slowing down. For example, in September, the All Items Consumer Price Index showed a 12-month inflation rate of 2.4%, and the Producer Price Index, which is a measure of wholesale inflation, was at 1.8%. Both of these point to inflation trending in the right direction. Goldman's projection that the PCE index will hit 2% aligns with tracking from the Cleveland Fed as well. However, it's important to note that inflation for the entire third quarter is running at just 1.4% on an annualized basis, which is well below the Fed's 2%. But here's the catch. Core inflation, which excludes food and energy and is often seen as a better gauge of longer-term trends, is still a bit high. Goldman estimates that core inflation for September will come in at a 2.6% annual rate, while the Consumer Price Index showed core inflation even higher at 3.3% for the month. A big reason for this higher core inflation is the shelter component, basically rent. The Fed expects this to ease over time as lower trends in rents start showing up in the data. Fed Chair Jerome Powell mentioned that housing inflation should continue to drop, which should help bring overall inflation down even further. From a policy standpoint, if inflation continues to fall, it opens the door for the Fed to cut rates even more, especially as they start paying closer attention to the labor market. But there's some caution here. The recent half percentage point rate cut in September, which brought the Fed's target range down to 4.75% to 5%, was a pretty bold move for an economy that's still expanding. So it's likely that the Fed will go back to its usual quarter-point rate cuts moving forward. In fact, some officials are even considering holding off on any rate cut in November. Atlanta Fed President Rick recently said he'd be open to skipping a cut altogether at the next meeting. The concern is that if the Fed moves too quickly to cut rates, it could reignite consumer demand just as it's starting to settle down. According to PNC senior economist Kurt Rankin, aggressive rate cuts could lead businesses to face higher costs as they scramble to meet rising demand, potentially pushing inflation back up. For now, though, futures traders are betting that the Fed will cut rates by a quarter point at both the November and December meetings. So, while there are still challenges, the signs are encouraging that inflation is finally heading back to the Fed's 2% target, giving them some room to navigate carefully as they work to keep the economy on a steady path.